During the 2008 financial crisis, the S&P 500 plunged nearly 40%. But did you know that certain gold ETFs surged over 25% during that same period? This illustrates a consistent economic pattern seen throughout market history. While most investors focus on what to sell during economic downturns, the wealthy focus on what to buy. Today, I'm breaking down the 6 specific ETF categories that have consistently preserved and grown wealth through every market crash of the last 30 years. The same categories billionaires are quietly loading up on right now. Stay tuned to uncover the investment strategies building truly recession-proof portfolios that most advisors never mention. Did you know that during the 2020 pandemic crash, investors pulled over $326 billion from an equity fund at the market bottom, right before one of the strongest recoveries in history? It's a striking example of how fear can drive us to make exactly the wrong financial moves at precisely the wrong time. When markets plunge, our brains don't exactly help us make rational decisions. Our psychological wiring actively works against us, triggering responses that might have helped our ancestors survive predator attacks, but devastate our investment portfolios. 2 powerful biases take control during market downturns: loss aversion and recency bias. Loss aversion makes us feel the pain of losing money about twice as intensely as the pleasure of gaining the same amount. Simultaneously, recency bias causes us to assume current market declines will continue indefinitely. Together, these create the perfect storm of maximum pain and pessimism, often leading investors to sell at the worst possible moment. This behavior gap explains why the average investor significantly underperforms the very funds they invest in. During volatile periods, emotional decision-making causes investors to buy high and sell low, the exact opposite of successful investing principles. Wealthy investors, by contrast, respond differently to these same market conditions. Take Warren Buffett during the 2008 financial crisis. While most investors frantically sold, Buffett invested $5 billion in Goldman Sachs, a move that eventually netted billions in profit. His approach to be fearful when others are greedy and greedy when others are fearful serves as a blueprint for capitalizing on market downturns. During market crashes, assets don't vanish. They transfer from emotional sellers to strategic buyers. The wealth doesn't disappear. It changes hands from those reacting to the moment to those planning for the decade. Recessions actually follow fairly predictable patterns. Certain asset classes consistently outperform during different economic phases. Defensive sectors like utilities and consumer staples typically weather downturns better than growth-focused sectors. Quality companies with strong balance sheets generally recover faster than speculative investments. Institutional investors understand this cyclical nature and position themselves accordingly. Rather than trying to predict exactly when recessions will start or end, they construct portfolios specifically designed to capitalize on the patterns that historically emerge during economic contractions and the recoveries that follow. This systematic approach stands in stark contrast to the reactive, news-driven decision-making that characterizes most retail investors' behavior. While news media profits from heightening fear, strategic investors use these sentiment extremes as indicators of potential opportunity. The good news? You don't need billions or special access to implement similar strategies. The right combination of ETFs can provide a sophisticated, recession-resistant portfolio that positions you to benefit from, rather than be victimized by, economic downturns. Unlike those institutional investors who calmly navigate market storms, most of us need a stabilizing anchor when our portfolio starts sinking. And that's precisely where gold ETFs enter the picture. During the last 3 market crashes, gold has moved in the opposite direction of stocks nearly 80% of the time, creating what financial analysts call a negative correlation that can dramatically reduce your portfolio's overall volatility. Gold serves as a lighthouse in financial tempests, standing firm while other assets are tossed by market waves. Its reputation as a safe haven is backed by centuries of evidence. When economic uncertainties rise, investors instinctively flee to assets with intrinsic value, and gold has maintained its worth across civilizations, languages, and economic systems. Its response during modern financial crisis reveals its unique position in the investment world. Look at what happens when fear grips the markets. As the VIX, often called the fear index, spikes during economic turmoil, gold typically begins its upward climb. This pattern reveals gold's psychological advantage. When everything else seems uncertain, gold's tangible nature provides a comfort that digital assets or company stocks cannot match. The 2008 financial crisis demonstrates this perfectly. While the broader market plummeted by 40%, gold climbed 25% in the opposite direction. This counter-cyclical movement shows exactly why gold deserves consideration in any recession-resistant portfolio. Many misconceptions surround gold investment, but contemporary financial planners view it as a mathematical tool for reducing portfolio volatility. When properly allocated, gold improves risk adjustment returns over full market cycles. Modern gold ETFs have eliminated traditional barriers to gold investment. Instead of dealing with physical storage concerns, insurance costs, and liquidity challenges, gold ETFs trade on major exchanges just like stocks, offering instant liquidity during market hours. This accessibility lets you quickly adjust your portfolio without the logical headaches of physical ownership. Several efficient ETF options exist for gold's exposure. The iShares Gold Trust ETF IAUM stands out with its low expense ratio of just 0.09%. Similar alternatives with competitive expense ratios are available, giving you flexibility based on your specific preference. Check the description below for a comprehensive list of recommended gold ETFs and their expense ratios. The question becomes how much gold to own. Too little limits its portfolio's stabilizing effects, while too much can unnecessarily constrain long-term growth. For most investors, strategically allocating between 5% and 10% of your portfolio to gold ETFs provide meaningful recession protection without significantly compromising your long-term growth trajectory. This balanced approach gives you gold's safe haven properties while maintaining substantial exposure to productive assets. Beyond portfolio protection lies an even more compelling recession strategy: getting paid while you wait for recovery. During economic downturns, certain companies with rock-solid balance sheets not only survive but continue sending dividend checks to their shareholders without interruption. This reliable income stream creates a powerful psychological advantage when your portfolio statement shows declining values elsewhere. SCHD, Schwab US Dividend Equity ETF, stands out during recession with impressive performance numbers. Returns exceeding 17% annually over 5 years and 11% over the past decade, all while maintaining a minuscule 0.06% expense ratio. These statistics reflect SCHD's focus on companies with proven track records of maintaining and growing dividends through economic cycles. Think about what happens during a typical recession. Growth stocks, those high-flying companies promising future profits but paying no dividends, often crash the hardest. Meanwhile, established companies with sustainable dividend programs provide investors with actual cash deposited into their accounts every quarter, regardless of market conditions. This creates emotional reassurance and financial power. Dividend investing during recessions operates like a well-maintained rental property during a hurricane. While the neighborhood experiences damage, your property continues generating rent checks. The value of the building might temporarily decline, but the income remains steady, and you're positioned to acquire more properties at discount prices. When most investors freeze with fear watching portfolios shrink, dividend investors experience a different reality. Each payment serves as tangible proof their investment continues functioning as designed, creating a stabilizing anchor that prevents panic selling at precisely the wrong moment. SCHD's sector allocation strategically weighs towards recession-resistant industries. Energy, consumer defensive, healthcare, and industrials form the backbone, providing essential goods and services that remain in demand regardless of economic conditions. This helps insulate your investment while positioning you for recovery. Top holdings include ConocoPhillips, Chevron, Coca-Cola, Bristol-Myers, and Altria Group, diverse businesses demonstrating extraordinary resilience by maintaining or increasing dividends through multiple recessions. These established enterprises possess financial strength to weather economic storms while rewarding shareholders. Dividend payments create additional opportunities during downturns through reinvestment at depressed prices. Each dividend automatically buys more shares when prices are low, accelerating recovery when markets rebound. This natural dollar cost averaging happens without requiring perfect timing or emotional fortitude, turning market downturns into wealth-building opportunities. For most investors, the ideal recession portfolio includes a 15 to 25% allocation to dividend value ETFs like SCHD. This provides meaningful income while positioning a significant portion of assets for recovery appreciation. Those closer to retirement might prefer the higher end of this range, while younger investors might allocate less while still capturing the essential benefits. When most investors were losing everything in 2008, one billionaire's portfolio actually gained 14% while markets collapsed around him. The secret wasn't perfect market timing or hiding in cash. It was a revolutionary asset allocation strategy now available to regular investors through a single ETF designed to withstand economic storms while still capturing growth potential. Ray Dalio, founder of Bridgewater Associates, credited the all-weather approach that transformed how sophisticated investors handle market volatility, and is revolutionizing recession protection for everyday investors. Most of us think in binary terms when economic uncertainty looms: fully invested for growth or completely defensive for protection. This leads to costly timing mistakes as we switch between strategies at the wrong moments. The all-weather strategy overcomes this problem by recognizing that economies move through four distinct phases: growth, expanding economic activity; recession, contracting activity; inflation, rising prices; and deflation, falling prices. Like a safety net that flexes rather than breaks under pressure, this approach acknowledges that different assets naturally thrive in each environment. By properly balancing these assets, you create a portfolio designed to perform well regardless of which economic seasons dominate. The ALLW ETF brings this sophisticated strategy to your portfolio through a calibrated asset allocation: 30% to stocks, divided between US and international markets; 55% to bonds, 40% long-term, 15% immediate; and 15% to inflation hedges, split evenly between gold and commodities. This structure works because these investments respond differently to economic forces. During recessions, when stocks decline, bonds often increase in value. When inflation rises, commodities like gold typically appreciate. This balancing act ensures you're never completely exposed to any single economic factor. The ALLW ETF charges 0.85%, higher than simpler ETFs, but dramatically less expensive than accessing this strategy through a hedge fund. For investors approaching retirement or those with lower risk tolerance, this premium represents reasonable insurance against market extremes. What makes this approach powerful during recessions is that it eliminates the need for perfect timing or economic forecasting. Instead of trying to predict when a recession will begin or end, you maintain a balanced position designed to weather whatever economic conditions develop. Historical performance shows how this approach minimizes losses during market stress while still participating in recoveries. By accepting moderate returns during bull markets in exchange for smaller losses during downturns, the strategy produces more consistent results across full market cycles. For a truly recession-resistant portfolio, consider allocating 20 to 40% to a balanced ETF like ALLW. Those closer to retirement might lean towards the higher end, while younger investors might stay at the lower end. This allocation provides a solid foundation that reduces volatility without sacrificing growth potential. Beyond strategic asset allocation, the most recession-proof portfolios tap into a fundamental economic truth most investors overlook. When money gets tight, what happens to your spending habits? You might cancel that vacation or postpone buying a new car, but you'll still buy toothpaste, soap, and pay your electric bill. This consumer behavior creates an extraordinary investment opportunity hiding in plain sight. This concept has a name in economics: inelastic demand. It means that regardless of economic conditions, consumption of certain products remain relatively consistent. During the toughest economic times, people still need to eat, wash their clothes, and keep their lights on. Consumer staple companies provide the products we use daily, regardless of economic conditions. The Vanguard Consumer Staples ETF, VDC, holds 103 companies that provide these essential products across America. With an expense ratio of just 0.09%, almost all your investment goes to work immediately. Plus, it currently offers a solid 2.4% dividend yield, providing meaningful income even during market downturns. Inside VDC's portfolio, you'll find household names that have weathered countless economic storms: Costco, Walmart, Procter & Gamble, Coca-Cola, and PepsiCo. These companies maintain stable cash flows during recessions because their products are the last things consumers cut from their budgets. Consider your own household. You might postpone a new smartphone purchase during tough times, but you'll still buy food, soap, and other daily necessities. Utilities represent services we literally cannot function without. The utility sector serves as perhaps the ultimate recession hedge due to regulatory protection. Most utility companies operate as regulated monopolies with guaranteed service territories and government-approved rates, creating predictable cash flows during economic uncertainty. The Utilities Select Sector SPDR Fund, XLU, provides exposure to this stability with an expense ratio of just 0.08% and a substantial 3% dividend yield. The ETF contains 31 major American utility companies like NextEra Energy, Southern Company, and Duke Energy, companies providing essential services with consistent earnings histories. When was the last time you considered canceling your water or electricity service to save money? These services represent the absolute last expenses consumers will cut from their budgets. Historical data shows that both consumer staples and utilities not only decline less during market crashes, but often recover months before the broader market, allowing investors to capture both protection during downturns and earlier participation in recoveries. For investors building a recession-resistant portfolio, consider allocating 10 to 20% to consumer staple ETFs like VDC and 5 to 15% to utility ETFs like XLU. This combination provides meaningful protection without sacrificing growth potential when markets recover. These recession-resistant sectors work beautifully alongside balanced ETFs like ALLW, strategically positioning your portfolio in assets that thrive during economic stress while transforming market volatility into long-term wealth opportunities. Let me share something fascinating about recessions. They're actually quite brief in the grand scheme of things. The average recession lasts just 11 months, while expansion periods typically stretch for 67 months. That's a 6-to-1 ratio in favor of growth. This perspective is exactly why our 6 ETF strategy works. It builds resilience to weather these short downturns while positioning you for the longer periods of prosperity that follow. By implementing this portfolio approach through consistent investing, you transform market dips into wealth-building opportunities. Are you ready to turn what most people fear into your greatest financial advantage?